And it's always, market participants are always really excited about FOMC because it creates volatility. Another opinion about that is that there's only 8 of these a year, and this extreme volatility that you see is kind of like going to Vegas, and you don't necessarily know how many decks of cards are in the blackjack pile, right? When you have a dedicated risk reward ratio, you know where the markets are going. You have probabilities in your favor. You can have a reasonably positive expectation. And there's only 8 of these a year. And I always like to just remind everyone to exercise caution on the day. And then, after the FOMC statement's over at 3 p.m., the whole trend begins. That brings us to, where we are in time and price right now. Where are we? We're exactly in the middle of the range between 2 opposing measured moves. And so that confirms for us that, this is a completely sideways day potentially. Notice that these 2 red lines above and below, those are unfilled gaps. So we could get tighter and tighter and tighter today. And then on the FOMC statement, we'll either break up to fill the gap from below or break down to fill the gap down here at the 4150s. But you could make a very good case here that from the consolidation, that as we're moving on into the afternoon, that we could fill both of those gap fills today in the volatility of the FOMC statement. The gap fill statistics for today, and we're inside of the 10 handle. And so we do have an expectation of a 98% probability for a gap filling. There's a 67% probability for the day. Now, there isn't necessarily anything that I could talk about right now that I didn't already touch base on inside of the market analysis video. So I wanted to touch base here on this study. And this is, again, based on this Gavel, and this is Charles Gavel, this study that or Gave, that I posted yesterday. I'll post it again in chat. And I want to go over this here in the next couple of minutes, and I'm going to do an official webinar on this. And there's an explainer below this, but I want to touch base on what it is and why it's important. And I'd like to encourage you to follow it with me over the next coming days and weeks, and to let me know if you see anything inside of that, any intricacies, any insights, but what exactly is it? You're essentially looking at the weather, and just like the stock market has seasons, hot, cold, wet, dry, the economy has seasons too. And so in the upper left, the economy is struggling and money is losing value at the same time. This is called stagflation. It's the most dangerous environment. It's the most dangerous environment for investors. Almost nothing works here historically. In the upper right is an inflationary boom. The economy is booming, prices are rising. It's called, think about wartime economies or periods of massive government spending. That's what that is. The deflationary bus is in the bottom left-hand corner. In the left quarter, the economy is struggling and money is still holding its value. Think about a dollar strength environment. That makes sense with where we are in time and price right now. Think about the Great Depression or parts of 2008. And the lower right is now. This stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.